Some investments get help from the taxman. For example, pensions get generous tax relief, and returns on ISAs are almost tax-free. But did you know there are investment wrappers which can reduce your income tax? Let's start with enterprise investment schemes. These were set up by the UK government in 1994. You get income tax relief of 30%. So if you invest £10,000, you can knock £3,000 off your income tax bill in the year that you invest. You'll pay no capital gains tax on any profits. If you make a loss on your investment, you can offset that loss against income tax. So let's say you lose your entire £10,000 investment and you are a higher rate taxpayer in the year of disposal. Because of income tax relief of £3,000, your actual loss is only £7,000. 40% of £7,000 means you get relief on the loss of £2,880. So your actual loss suffered on the investment is £4,120. That's not bad downside protection for a high-risk investment. There's no inheritance tax to pay on shares bought through an enterprise investment scheme if shares are held for more than 2 years. This could save you 40% inheritance tax, plus you keep control of the asset, unlike other forms of estate planning, such as gifting assets, where you lose control. These are high-risk investments with generous tax incentives. They are mainly suitable for wealthy investors with higher risk appetite, seeking to reduce their income tax bill. They are very difficult to sell as there is no secondary market. The main hope is the company will grow and become listed on a stock exchange. Some EIS fund managers offer pooled products to spread the risk across several companies. Now let's look at venture capital trusts, or VCTs. These are more like mutual funds or investment trusts, as there is a greater number of companies held. So the risks are smaller than the EIS, but still remain high. You are still investing in small companies. You also get 30% off your tax bill in the year of investment, so a £10,000 investment will reduce your tax bill by £3,000. You acquire £10,000 worth of shares for £7,000. The main focus of VCTs is dividends. They are paid almost tax-free. An investor who is seeking income may find these attractive. There is no capital gains tax on disposal. Again, they are more suitable for investors with higher risk appetites. For example, a very high earner who has already used their annual £40,000 pension allowance may find the tax relief available on VCTs and the possible future tax-free income from dividends very attractive indeed. Now let's turn to seed enterprise investment schemes. They are very similar to EIS, but designed for investing in even smaller companies. And due to the higher risk, the government provides even more generous tax breaks. 50% tax relief is available in the year of investment, so you get £5,000 off your income tax bill for investing £10,000 in an SEIS. As with EIS, there's no capital gains tax to pay on profits, no inheritance tax, and you can claim loss relief in the same way. There is an extra relief called Capital Gains Reinvestment Relief. This is useful if you have recently paid capital gains tax on other investments. You can reclaim up to 50% of the tax paid if you reinvest that money into a seed enterprise investment scheme. If a £10,000 investment completely fails and you have sufficient income in the year of disposal to use all the available tax reliefs, the failure will only have cost you £1,350. That's because you can claim £8,650 in tax relief on a loss of £10,000. This might be appealing to directors of small limited companies, as they can invest in their companies in a very tax-efficient way. Finally, for all these investments, you can only reduce your income tax to zero. The taxman won't actually write you a cheque, so you must have sufficient income in the year of investment to qualify for the full tax relief available. Question is, are these suitable for you? Contact us today for further information. Thank you.